Welcome to today's deep dive. Since you're already operating at an expert level in machine learning and quantitative finance, you know exactly how frustrating standard anomaly detection can be.
Oh, absolutely. It's a complete headache.
Right. I mean, if you break your arm, an X-ray gives you this clean binary answer. You look at the film, see the jagged white line, and the diagnosis is absolute.
Yeah, but if you are a quant staring at multidimensional, highly autocorrelated market data.
That X-ray machine is entirely useless. You are just swimming in noise.
Yeah.
And those classical anomaly detection methods, they just start generating false positives the second the market twitches.
Exactly. The standard diagnostic landscape for market data is fundamentally broken, mostly because classical change point detection methods, or CPD, they rely on these incredibly strict parametric assumptions.
You're forced to assume the data between regime changes fits some neat Gaussian distribution.
Right, or you're relying on online algorithms that just demand an enormous amount of new data to actually be confident in a shift. Horvath and Issa, the authors of the paper we're unpacking today, they frame this latency in terms of the epsilon real-time value.
And if that epsilon, basically the delay required to gather statistically significant evidence, is too high, well, your algorithm confirms the regime change long after your portfolio has already been wiped out.
Exactly. You get the confirmation, but you're already broke.
Not to mention how these classical models completely collapse in multidimensional or deeply non-Markovian settings. When you are tracking, say, a basket of 50 equities with deep autocorrelation in memory, traditional anomaly detection just drowns.
It really does, which is why the core paradigm shift of this paper is so compelling. Horvath and Issa basically bypass the traditional analysis of return distributions on the real number line altogether.
Just throw it out?
Pretty much. They shift the analytical framework directly onto path space. And they achieve this using rough path signatures and a highly specialized signature kernel maximum mean discrepancy metric, or MMD.
Moving from analyzing independent data points to continuous geometric objects, it changes the entire foundation of the detection pipeline.
It has to. I mean, to flag a market regime shift in real time with an incredibly sparse amount of incoming data, we have to fundamentally alter the mathematical representation of the stream itself.
Okay, let's unpack this.
Yeah.
Because embedding a discrete tick data stream into a continuous path, it requires a highly specific construction.
Yeah, it's not trivial. They use linear interpolation to connect the discrete observations, but then they introduce this really strict topological requirement.
Time augmentation, right?
Exactly, time augmentation. They add a monotonically increasing time channel directly into the data matrix.
So a one-dimensional price stream basically becomes a two-dimensional continuous path in space and time.
Right. And you need that time augmentation because otherwise the rough path signature map is only unique up to what we call tree-like equivalence.
Tree-like equivalence. So for anyone rusty on their standard rough path theory, what does that mean practically?
Well, imagine a financial assets price moves from, say, $100 up to $105 and then drops straight back down to $100.
A round trip.
Yeah. The geometric signature might interpret that retracing as essentially canceling itself out. It effectively erases the event from the mathematical record.
Oh, wow. So it wouldn't even register that volatility spike.
Exactly. But by appending a strictly monotonic time channel, the path is forced continuously forward in that added dimension. You physically cannot retrace the exact same path.
Because time only moves forward. That's brilliant. It ensures the signature mapping becomes truly universally unique.
It does. And another crucial property of these path signatures is that they are completely invariant to time reparameterization.
Which is huge for high-frequency financial data. Your tick frequencies are wildly irregular. You might have a massive flurry of microsecond trades followed by like a 10-second gap.
Right. And classical models hate that irregular spacing. But because the signature evaluates the geometric sequence of the path rather than the rigid time-stamped velocity, you don't lose the structural information of that data burst.
It's like instead of just analyzing a static histogram of a stock's daily returns, we are capturing the exact sequential geometric footprint of the price evolution.
That's a great way to visualize it.
The signature doesn't just know where the path went, it knows the order, the curvature, and the intensity of every single twist and turn along the way.
And working with subpaths, basically sliding windows moving across this continuous data stream, allows us to reframe anomaly detection entirely.
So we aren't looking at static histograms anymore.
No, we are evaluating compactly supported empirical measures on path space. We stop looking at independent random draws from a probability distribution and start looking at the continuous geometry of the information flow.
But I'm looking at the mechanics of this signature computation, and I immediately see a massive bottleneck. A path signature is an infinite dimensional tensor series.
Yeah, the math gets very heavy, very fast.
If you map out an asset's trajectory into an infinite tensor algebra to capture all that geometric nuance, you hit the curse of dimensionality instantly.
You do. And standard machine learning literature deals with this by heavily truncating the signature.
Right. You calculate the first 2 or 3 levels of the tensor algebra, assume the factorial decay makes the higher order terms irrelevant, and just drop the rest to save compute.
That's the standard playbook, yeah.
Wait a second. In most literature, people justify truncating signatures by arguing that factorial decay means the higher order terms just don't matter. Why is that assumption fatal here?
What's fascinating here is that the numerical size of a higher-order tensor term does not dictate its statistical relevance. Not when you're trying to distinguish between two complex probability distributions.
So a tiny number can still be the exact feature that proves the market just broke.
Exactly. If you truncate a signature at level 3 or 4, you entirely miss the subtle distributional shifts caused by higher-order moments. Horvath and Issa proved this definitively by running synthetic data experiments.
Using the Merton jump diffusion model.
Yes, and jump diffusions introduce massive, sudden spikes in volatility, which fundamentally alter the kurtosis and the heavy tails of the marginal distributions.
Right, and a truncated signature at, say, level 2, it captures the variance fine, but it is completely blind to those
It's
jumps.
completely blind. To capture those jump dynamics, you theoretically need signature levels well beyond order 4.
Which would melt any normal computer.
It would. So, to bypass this truncation trap entirely, the authors deploy a signature kernel trick.
Okay, a kernel trick. How does that save us?
They calculate the signature maximum mean discrepancy, the MMD, without ever explicitly mapping the paths into the infinite dimensional tensor space.
Oh, wow. So they skipped the infinite mapping entirely.
Yeah, they compute the inner product directly within the reproducing kernel Hilbert space. They usually do this by solving a specific Gorsat partial differential equation.
It is an incredibly elegant workaround. I mean, in their synthetic tests, the untruncated kernel MMD vastly outperformed the truncated version.
Like the standard K-signature metric.
Yeah, it was way better at isolating the exact moments the Merton jump diffusion model shifted regimes. It intrinsically absorbs the kurtosis and the jump dynamics.
And here's the best part. The computational cost of this Gorsat PDE kernel trick scales linearly with the path dimension.
Linearly. That's insane.
Yeah.
So you can feed this metric a high-dimensional input, say 50 different autocorrelated assets, without triggering an exponential explosion in compute time.
Exactly. We now have a highly sensitive, dimension-agnostic metric that actually preserves infinite dimensional geometric features.
But then the engineering challenge is wiring that metric into a live, real-time pipeline.
Right. And the paper structures this as the market regime detection problem, which is centered around a concept they define as beliefs.
So what does this all mean for the actual data pipeline? I mean, beliefs are essentially the agent's definition of the normal state, right?
Yeah. They are compact sets of paths generated to represent the baseline market regime.
So you could generate these parametrically, like spinning up thousands of paths from an STE solver calibrated to your target volatility.
You could, or you could generate them non-parametrically, sampling historical data directly or pulling sequences from a pre-trained generative ML model.
Got it. Essentially, you can define your normal market state using an advanced generative model, and this algorithm acts as an ultra-sensitive tripwire, instantly flagging when the fundamental data-generating process has drifted.
That's exactly it. That belief set forms our null hypothesis. As the live market data streams in, the algorithm runs a sliding window of size n over the path.
Creating an empirical measure denoted as delta x.
Right. And then the detector deploys an unbiased U-statistic estimator of the squared MMD to continuously run a two-sample test. It's comparing the incoming data's empirical measure against the null distribution of the beliefs.
So it is constantly asking, does the geometry of the last n minutes of trading statistically match the geometry of my generative model?
Yes. And it doesn't just spit out some generic, uncalibrated anomaly score.
No, the statistical output is rigorous. The system outputs a predefined critical value threshold, calculated via permutation testing, to achieve a specific confidence interval.
Usually like a 1 minus alpha% critical value. And as long as the rolling MMD score of the incoming path ensemble remains below that calculated critical threshold, The data conforms.
The algorithm confirms the fundamental process is intact.
Right, but the moment the MMD score breaches that threshold, the tripwire snaps.
We officially have a regime change.
Exactly. We have definitive statistical proof of a regime change, which allows an automated system to instantly halt trading or recalibrate.
Which is amazing. But there is a massive structural hurdle here that standard MMD struggles with, and that is market memory.
Oh yeah, financial data is deeply non-Markovian.
Right. Volatility clusters. A volatility spike today is heavily conditioned on a market crash yesterday, but standard rank 1 MMD operates on static empirical measures, effectively aggregating away the timeline.
It tests finite dimensional distributions, sure, but it completely strips out the underlying filtration of the stochastic process.
So a rank 1 MMD cannot natively test conditional distributions over time.
No, it evaluates the shapes of the paths in the basket, but it ignores the sequential dependencies governing how one path actually evolves into the next.
Which is a huge blind spot for finance. To solve this, Horvath and Issa introduced the rank 2 expected signature to the detection framework.
Yeah, the rank 2 signature is the key to non-Markovian data.
Here's where it gets really interesting. Think of rank 1 MMD like looking at a single month of market data and seeing, say, 15 distinct high volatility days and 15 low volatility days. The overall distribution is clear.
Right, you know the mix, but not the order.
Exactly. But rank 2 looks at the filtration. It sees that all 15 high volatility days happen consecutively, immediately following a macro liquidity shock.
It preserves the exact sequential memory of the market. It captures cause and effect.
Rank 1 is like looking at the final average grades of two different classrooms. Rank 2 is looking at those grades conditioned on the student's midterm scores.
That's a perfect analogy. The math behind this leverages recent advancements in rough path theory, mapping measure-valued discrete time paths into a second-order tensor space.
So, by computing the rank 2 maximum mean discrepancy, the algorithm explicitly tests the conditional transitions.
Yes. And to validate this, the researchers targeted the rough Bergomi model.
Which is notoriously brutal to track.
Oh, it's a very difficult stochastic volatility model. It's designed specifically to replicate the deeply non-Markovian rough nature of empirical volatility surfaces.
And simpler models completely failed to distinguish regime switches in rough Bergomi data, right?
They failed entirely, but the rank 2 detector successfully tracked the transitions.
The accuracy gains are substantial, but the computational tax is heavy.
It is. This raises an important question regarding deployment architecture, because the theoretical superiority of rank 2 is undeniable.
In the non-Markovian switching benchmarks, the rank 2 detector improved the total accuracy from 77.9% up to 83.3% compared to the rank 1 variant.
Which is a massive jump. It drastically reduces type 2 errors during critical transition phases.
The algorithm recognized anomalous structural breaks that rank 1 completely smoothed over.
Yeah, but the benchmark tests showed the rank 2 detector taking roughly 81 seconds to compute a rolling window.
81 seconds. Compared to what for rank 1?
Compared to under 1 single second for the rank 1 variant.
Wow, it is nearly 100 times slower.
Yeah. And in quantitative finance, an 80-second compute cycle is an eternity, depending on your execution frequency.
You have a direct formalized trade-off. If you are a macro fund or a longer-term options desk where an 80-second reaction time is perfectly acceptable and you absolutely require high-fidelity tracking of non-Markovian dynamics, rank 2 is your optimal tool.
Right. But if you are operating a high-frequency market-making engine where sub-second reactivity is pure survival, you deploy rank 1.
You just accept the slightly higher theoretical error rate to maintain latency.
Exactly. That hardware constraint is real. But the laboratory results on synthetic Merton diffusions and rough Bergomi models, they absolutely prove the mathematical foundation.
So it works on synthetic rough volatility and jump diffusions. But how does this untruncated pathwise MMD perform on the chaotic, noisy reality of actual historical market data?
They actually stress tested this framework outside the lab. They deployed it against hourly close prices for the highly volatile BTC to USDT cryptocurrency pair.
Crypto is the ultimate stress test.
It really is. They also tested it against a high-dimensional basket of traditional equities, including the S&P 500 index.
And they fed the algorithm the immense volatility of the 2020 and 2021 markets.
Yeah. And the detector accurately isolated the precise transitions into the major cryptocurrency bull runs.
But the truly impressive result, at least to me, was its ability to recognize sustained, massive variance as just being normal.
That's the power of the memory and the beliefs. The algorithm absorbed the standard wild swings of crypto without throwing false positives.
Right. It didn't trigger an anomaly alarm just because the price moved 10%. It only snapped the tripwire when the fundamental nature of the underlying volatility drifted.
Exactly. It successfully isolated the distinct structural breakdowns during the market turmoil of mid-2022 while ignoring the everyday noise.
If we connect this to the bigger picture, the exact same continuous path principles powering this online detection scale seamlessly to offline data analysis, right?
Yes, they do. The authors formalized the market regime clustering problem, or MRCP.
So doing this offline.
Right. Because the signature kernel trick handles infinite dimensional features while scaling linearly with the number of input assets, they successfully clustered high-dimensional equity baskets across decades of historical data.
Decades of data. And this natively outperforms traditional Wasserstein-Key-means algorithms.
Oh, massively. Wasserstein-Kamen's algorithms are computationally devastating to run beyond a single dimension.
So you can feed a deep historical data set of 50 correlated assets into the MRCP framework, and it will objectively segment the market history into mathematically distinct geometric regimes.
And it does it entirely free of human parametric biases.
That is huge. For quantitative practitioners, this provides a completely data-driven pipeline.
It functions as an autonomous early warning system for deep hedging engines and complex portfolio optimization algorithms.
Because currently, many of these machine learning models are trained on narrow distributions representing a very specific market state.
Right. And when that state breaks down, the optimization engine doesn't wave a flag. It simply begins executing suboptimal trades because it is optimizing for a reality that literally no longer exists.
But with this new pipeline, the MMD detector is placed immediately upstream of the execution engine.
Exactly. It continuously evaluates the incoming path geometry against the training beliefs, acting as an empirical gatekeeper.
The moment the underlying distribution drifts, the detector explicitly tells the execution engine to pause and recalibrate before actual capital is lost.
It is just a remarkable synthesis of rough path theory and kernel methods applied to live data streams.
We are looking at a massive leap forward for working in multidimensional, sparse data environments. I mean, embedding discrete streams into continuous time-augmented path space perfectly handles erratic tick frequencies.
Yeah, and leveraging the Gorsat PDE kernel trick bypasses the truncation trap completely. You seamlessly capture higher-order kurtosis and jumps without melting the GPU.
And for assets driven by deep memory, the rank 2 expected signature directly incorporates the underlying filtration.
It fundamentally upgrades the speed and statistical rigor with which we can detect structural breaks in highly complex systems.
Which leaves us with a fascinating implication to consider.
Oh, what's that?
If this untruncated signature MMD is so hypersensitive that it can flag the breakdown of a complex SDE with just a handful of observations, could this exact mathematical metric be utilized as the core loss function to dynamically train a completely new class of adaptive trading algorithms?
Oh, wow. Using it actively instead of passively.
Exactly. We might be looking at the foundational math for autonomous agents that continuously and natively recalibrate their own internal weights before human analysts even realize the broader market regime has fundamentally shifted.
The transition from using MMD as a passive observer to an active driving loss function, that is definitely the logical next frontier.
Something to think about. Thanks for joining us on this deep dive into path space. Keep questioning the models, and we'll see you next time.